In this video, we're going to look at some more examples for earnings per share. Pause the video, read the question, and then continue. In this question, they've given information for Daisy Company. Daisy Company's net income is provided. They've told you what the capital structure is, how many shares they've had outstanding, and then they've told us about the dividends paid. What they want you to do is calculate earnings per share for 2021. First, let's look at the formula to calculate earnings per share. I know it's really small, but it says earnings per share equals net income minus preferred dividends, and then the whole thing is divided by the weighted average common shares outstanding. In item 1, they told you how much net income the company made, so that takes care of net income in the formula. The next part is subtract preferred dividends. Well, they don't mention anything about preferred stock. They do mention about dividends in part 4, but since there are no preferred stock mentioned, the entire dividend will be paid to common stockholders. So we do not need to worry about the preferred dividends part of the formula. Now let's take a look at the denominator. In the denominator, we need the number of common shares outstanding. So let's look at what they had. Step 2 says on January 1st, 2021, the company had 100,000 shares of common stock issued and outstanding. Then step 3 says on 6/1/2021, they issued an additional 60,000 shares of common stock. Since the company didn't have the same amount of stock during the entire year, we need to calculate the weighted average amount of the common stock. Let's look at a timeline. When you draw a timeline, we know that they had 100,000 shares for the entire 12 months. Then on June 1st, they issued another 60,000 shares. These 60,000 shares were only held for 7 months. Now we're going to learn how to calculate the weighted average common shares outstanding. Again, it's not a simple average where you're going to take the beginning of the year plus end of the year divided by 2. We're going to take into account when these shares were issued. So to calculate the weighted average number of shares outstanding, you're going to start off with the shares that were there for the entire 12 months. So what this fraction is the time period that the company had these shares outstanding. So the 100,000 shares were outstanding for 12 months. That's the numerator. And then the denominator represents number of months in a year. That's why we say 12 out of 12. And I know this is going to end up being 1. So later on, you'll see that this is just going to be the same as saying 100,000. Now we're going to look at the next portion, which is the 60,000 shares that they issued on June 1st. Use your fingers to count the number of months from June to December, and you'll find that it's 7. June, July, August, September, October, November, December. That's 7 months. So we're going to do the same thing for the 60,000 shares. When we do that, again, we're going to add that. We're going to say 60,000 multiplied by 7, because that's the number of months that these shares were outstanding, divided by 12, which is how many months are there in a year. This simplifies into 100,000 plus 35,000, which is 135,000. That is the denominator of your earnings per share calculation. Now that we have all the information, we can go ahead and calculate earnings per share. Earnings per share is equal to net income, which is 500,000. We don't have any preferred dividends, so we don't need to subtract anything, divided by the weighted average common shares outstanding, which is 135,000. That gives us an earnings per share of $3.70 for 2021. Let's take a look at another question. Pause the video, take a minute to read the question, and then continue playing the video. Let's first look at the earnings per share formula. Earnings per share is equal to net income minus preferred dividends divided by the weighted average common shares outstanding. Net income is easy. They give that to us in the first part, so we've already got that part of the calculation. They told us in part 4 that the JR Company's board of directors declared and paid a $200,000 dividend. They don't mention anything about preferred stock, so that entire $200,000 dividend is attributable to the common stockholders. And if that's for common stockholders, we don't need to worry about that because that's not part of our formula. So that takes care of preferred dividends. But they do have multiple stock transactions, so we do need to worry about the weighted average part of the formula. So let's start by putting a timeline. So during the year, they had 1 million shares, but only for 8 months of the year. Why only 8 months of the year? Because the third point says on 9/1/2021, the company reacquired 400,000 shares as treasury stock. You know that when a company has treasury stock, what they're doing is they're buying back their own shares. So on 9/1, they bought back 400,000 shares. So let's go ahead and put that on the timeline. So 400,000 shares got subtracted from 1 million, so they only had 600,000 shares for the rest of the year, which is 4 months. So now that we know what their capital structure was during the year, we can calculate the weighted average common shares outstanding. So the weighted average common shares outstanding is equal to the 1 million shares multiplied by a fraction of 8/12. The 8 represents the number of months that they had a million shares, and the 12, of course, represents the number of months in a year. And then you would add how much shares they had for the rest of the period. So we know that for the rest of the 4 months, they only had 600,000 shares, and they had 600,000 shares for 4 of the 12 months. When you simplify that, you get 667 plus 200,000, which is equal to 866,667 shares. Now that we have the weighted average shares outstanding, we can go ahead and calculate the earnings per share. Earnings per share is equal to net income, which is 3 million, divided by 866,667, which is the weighted average common shares outstanding, which gives you an earnings per share of $3.46. That's when you round it to 2 decimal places. If this question said that on December 1st, they resold some of the treasury stock, you would have to make sure that you adjust for that treasury stock selling back. So now those shares would become outstanding. Remember, whenever a company has treasury stock reduces the amount of common shares outstanding, but when those treasury stock are reissued, the common stock outstanding increases. That's it for earnings per share videos.